rolling. 4, 3, 2, 1. Hello, everyone. We're truly happy to welcome you back on board for our third and final episode of our AI Spotlight series, Insurance 4.0. With our first industry showcase series, we have focused on how AI is impacting and augmenting financial services from the banking and wealth management industry to the insurance sector. We're introducing you to industry leaders and high-end entrepreneurs from different geographies for a best practice guide on applying the latest AI to financial services processes. A little bit of fantastic speakers background. Joining us from Luxembourg City Center, Mr. German Casignani, CEO and co-founder of Motion S, a spin-off of the University of Luxembourg, founded in 2014. Germany received a master's degree in computer science from the University of Buenos Aires in Argentina and a PhD degree in computer science from Institut Mines Telecom in France, one of the best, by the way, in France. He also serves as a research associate at the SNT, and he's a research fellow at the University of Luxembourg and an adjunct professor in management at the Sacred Heart University, still in Luxembourg. Joining us from Paris, Ms. Adina Gregorio, CEO and co-founder of Active Asset Allocation, a fintech with a proven track record designing bespoke investment solutions based on a proprietary risk management methodology and delivering them through an integrated digital platform with the help of artificial intelligence engines. AAA also provides life insurance with a Robo Advisor, allowing advisors to define and simulate a customized savings projects for their clients. With more than 2 billion assets under advisement, Active Asset Allocation boasts many large organizations among its clients. Adina has been awarded the Lady of FinTech recently, and we are proud to have you with us. Mr. Nigel Walsh is Managing Director at Google Cloud, where he leads the insurance business in North America with Yolande Piazza, VP Financial Services at Google Cloud. In his previous role at Deloitte, he was in charge of driving insurtech technology transformation and digital in the world where insurers and reinsurers are increasingly looking to adopt advanced technologies. From May 2010 to September 2016, Walsh worked at Capgemini as Vice President, Head of UK Insurance, where he was responsible for building and developing the UK insurance operation. Nigel is also the co-host of the InsurTech Insider podcast for 11FS and has co-authored both the AI and InsurTech books. On the moderator side, we have Miss Alessia Bonanno, Country Manager of BTO Research. After living and working for several years in Latin America, Alessia landed in Luxembourg in 2017 to manage the local subsidiary of BTO Research, an independent research center focused on IT and digital, with the mission to create a bridge between academia and businesses and to support companies in their digital reinvention. Thank you to all for being with us today, and the screen is yours. Alessia, please.
Thank you, Anthony, for this introduction, and thank you to our guests and panelists for taking part in today's session. So, hello, everyone, and welcome to the last episode of the AI Spotlight series focusing on Insurance 4.0. It's an honor for me to be here today with you and to have you all connected with us. So in the last few years, we've been seeing a rise in insurtech, especially leveraging artificial intelligence. And even though insurance companies are facing some challenges, they have been experimenting with new models to fully leverage the opportunities AI is opening up for them. So with our great guests today, we will be discussing about opportunities and challenges, but we're also going to understand the importance of the ecosystem and how to implement a successful strategy. After our discussion, you will be able to attend one of two workshops. The first one will be on data-driven insurance for connected vehicles, and the second one will focus on artificial intelligence for risk management and asset allocation. So, without further ado, I would start by getting to know our panelists a bit better. Could you guys please introduce yourselves and tell us a little bit about your current role? Maybe Nigel, you want to start?
Yeah, sure. Well, good afternoon, good morning, depending on where in the world you are. Delighted to be here. I have never heard a more excitable introduction to all of us. I thought that was outstanding. I'm not actually sure how I can follow it. So Nigel Walsh, I have just joined Google Cloud, as mentioned, to lead the North American insurance business. I should say that I am an employee of Google as opposed to a spokesperson. Most of what you'll hear from me today is very much focused on my prior 5 years, where I spent time at Deloitte, to Anthony's point, leading the global insurtech, global future of insurance, but also helping companies build new businesses from scratch in rapid time, to which we did for many non-insurers. And that should be a real eye-opener for many of the folks in the insurance world today to go, to your point as well, about what are we doing around partnerships and much more. And like Anthony, I am an insurance super geek. I thoroughly love this. My personal mission is to make insurance lovable, which everyone smiles about, and I will come back to later on.
Thank you, Nigel. So, Adina, would you like to go next?
Sure. Hello, everybody. Really excited to be here. And exactly as Nigel just pointed out, that was a hell of an introduction. So thank you so much. I'm an actuary by training, and I've been doing financial markets for over 20 years now. Started with trading, then asset management, then applied research, and finally co-founding active asset allocation 10 years ago. So I really initiated the firm as a financial engineering company. And with time, it has emerged as a fintech. We are on a mission, right? And our mission is to give financial institutions the relevant tools to really maximize their asset return and those of their clients, while providing downside protection to ensure financial security. So happy to talk about AI and all the exciting things that are happening in the insurance world. Thank you.
Thank you, Adina. Herman, would you like to go next?
Yes, first of all, thanks for inviting us to present in this event. I'm Herman Casignani, I'm CEO at MotionS and also co-founder. Actually, MotionS is a company focusing on data analytics and data science for mobility data, working mainly and originally with insurers to roll out insurance telematics products, but very recently also started to work with fleets, using our platform also to solve the problems of fleets in terms of fleet optimization, total cost of ownership.
Great, thank you for the introduction. So Herman, I would like to start with a question for you. What is limiting insurers today to massively roll out data-driven insurance?
So first of all, we have to say, I think that insurance is a data-driven business because it's all about data. It's all about collecting data from claims, analyzing it, trying to do a good segmentation and understand what is the underlying explanatory power of those claims to generate competitive and good tariff. The problem is today that we face an era in which data is no longer static, it's dynamic, and you have much more explanatory variables to build the insurance products, and that is I would say, challenging the insurance in many aspects. The first one, I think, is the skill sets that they have. Of course, insurance is based on solid actuarial sciences. For 100 years, actuaries have been developing nice models to cover risk. Today, they are, I would say, challenged by a more change of mind from the actuarial traditional perspective to a more data-driven perspective, and maybe introducing AI into models that have been working for decades using GLMs is a challenge for them. The second, I think, is more also about the regulation and privacy. There is a lot of data, but sometimes that data cannot be used for the purposes of insurance in some regions. And sometimes people is not willing to share the data, so the final customer. So it's actually all about looking for the good scenarios in which a piece of that dynamic data can be used to do a better model than what we have today, and that's not really evident. And I think the third problem that is limiting is, in terms of skills again, is when we talk about dynamic data, we need to manage data pipelines, meaning we need to collect the data in, I would say, more or less real time in order to feed it into a model. In traditional insurance, the data is normally collected once on premium generation and then every claim. So the link to data is much more, I would say, slow and static. I think these are the three main limitations. But maybe the other colleagues here, they would like to complement on that.
I'll chime in very quickly just to say it's not necessarily limitation. I was on a panel yesterday with two of our actuarial team from Alphabet, and they were sharing, you know, the volume of data that we've got, the ability to access it quickly and whatever else, whether it's structured or unstructured. These are not problems that are new. These are problems, to your point, the business has always been a data-driven business from,
Exactly.
you know, Edward Lloyd back in Lloyd's of London all those years ago. I started my career in manufacturing, and seeing something physical go in and physical go out is really exciting. When you don't have that, you've got to get this into much better shape. So the thing for limiting for me is often we spend too much time trying to get everything in order before we start work.
Yeah.
And often with the new tools, the new capability, the new speed that we've got, we can get going much faster.
Yeah.
Thank you both for answering. So another question for both you, Hidman and Nigel. So what are the most relevant use cases combining AI and IoT today? Maybe Nigel, you want to go first this time?
You want me to? Yeah, look, I think there's so many, and for years I was obsessed. I'm a technology super gadget freak. I love it. I love anything that's connected, from my water bottle to my watch to my house to my building to my car. Everything's connected, and I used to obsess about IoT until a point I got actually it's just a stream of data that's coming in. So it was just another endpoint or sensor, whatever it might be, and actually the use case was stronger than the technology. So it's trying to work out and narrow down now, because otherwise we spend too much time going, hey, look at all these answers possible, but don't actually get into the how do we go, you know, an inch wide and a mile deep. So I think I'd break this down to line of business or area, because you can start very quickly to go, actually, I want to do, as many of the carriers and folks will know, I want to do supply chain logistics. To that, my measurement is number of cars produced per hour on a factory line, or whatever it might be. I guess where I'm going is we've got to work out what we're optimizing for. Are we optimizing for the supply chain and making sure that's all working? Are we optimizing for health? Are we optimizing for long-term care? Are we optimizing for driving or risk? So putting all those things together into the right use cases, to be fair, you can have a use case almost in every single sector by bringing these two things together. All you're doing, to the earlier point, is bringing more frequency and a stream of data back into the model at a much greater pace.
Exactly.
Hidman?
Yeah, I fully support what Nigel just said. I'm also a fan of IoT at home, and I think that in terms of the question is which are the I would say the use cases that are there, and I agree with Nigel that there are kind of solutions for driving. So car telematics. In some countries there is a lot of projects being done on health using wearable devices. In some other countries also for home insurance, when you connect to your alarm or to the IoT system controlling your house. But everything is kind, you know, these are separate initiatives. But now when you see that people, you know, they buy a house, they get everything connected, you could maybe centralize it and have one point of sharing data for multi-risk. So the problem is that we think an insurance for covering one or a couple of risks, and maybe we need to think it more broadly and say, okay, I want to insure myself, my mobility, for example. And my mobility is everything. Is the car, is the bike, is when I walk, is when I take public transportation, and all that could be explained with the smartphone, right? So I think we need to think a little bit broader on the product design of the insurance too, in that sense.
Not that it's lunchtime or I like cake, but I wrote a piece a while back that I always go back to, which is exactly to this point. We're product centric. We still remain product centric, and as I said, it does differ depending on commercial versus personal versus whatever line of business we're in. But we've become too product centric, and that's only going to narrow our field of vision rather than make it bigger. We don't walk into a cafe or elsewhere and say, I want eggs, flour, blueberries in a case. We say, can I have a blueberry muffin? But I think insurers and the current, and there's lots of reasons for this, whether it's regulation or otherwise, we make you, we let you buy the ingredients, but we make the customer do the baking. Yeah. And I think sometimes we're going to get to the stage where actually we're just going to start selling you the cake. All the things that are around it. Sadly, we don't love insurance, but we love the things it enables us to do. It enables us to drive from A to B. It enables us to be in a building, fly on vacation in the old world. So there's loads of, I think there's loads of things that we should and can be doing as we start to change this going forward.
Thank you. And the other question for both of you is, what are the challenges for both carriers on one side and for providers on the others? Hidman?
Yeah, I think that we might have covered a little bit that in what we said before. For me, one of the big challenges is what Nigel just said. We need to see more the opportunities and to start seeing how to feed, technology and data into an existing product. Maybe we need to split it into the ingredients. But there, I think, apart from, from the conversation I had with the insurance when trying to do new projects, regulation comes really often to the table. IT also comes there as an issue for some of them, not for all of them, and data privacy again. So I think it's around there.
I always challenge that regulation is actually a bigger creation of innovation than people think. It's often used as we can't do this because. But if we change our mindset to imagine these are the rules of the game, and the rules of the game always change. I'm not going to mention Super League football throughout Europe, don't worry, but the rules of the game always change. And as long as we know that they're there and they can change, back to one of the earlier points, one of the things that we're trying to bake into our businesses, as always, is agility and speed. But if we keep measuring the new world in the old way, we're going to end up in this exactly the same spot and finding reasons we can't do stuff, not reasons we can do stuff. So I'd actually argue regulation should be seen as a way in which we can innovate rather than restrict.
Exactly, yeah. Explain not to the lawyers, not to the IT guys.
Thank you very much. Actually, regulation was one of my next questions. So I would ask Adina to intervene and tell us, in her experience, what is the impact of regulation and cybersecurity on the adoption of AI in the insurance sector?
Yeah, so I think that, of course, regulation is a source of innovation. But it's true that for now, it probably slows a little bit the adoption of AI in the insurance sector. Why is that? Because AI is all about data, as everybody knows. And the regulator is basically concerned about this data privacy, fairness, discrimination, security, all these things. AI, it's also about computing power and interconnectivity. So cybersecurity requirements might come in the way, but I think that AI is also a powerful tool to increase the KPI in the insurance sector. So and it has already penetrated basically all the aspects of the insurance sector, from customer service to products, pricing, distribution, everything. So there's no question about the fact that AI adoption will continue to increase, regulation helping or not.
Great, thank you, Adina. And also, I would like to ask you, what are the main, since we've spoken about IoT, what are the main applications of AI-backed Robo Advisors?
Right. So here we are really in the field that I know, which is the one related to investments in life. So it's life insurance, basically. Well, you guys will know more about the other side of insurance. For me, AI-backed Robo Advisors are very powerful tools to be used for augmenting the agent. So they can actually concentrate on the client and not on the product. So the Robo Advisor will allow for me enriching both the agent and the client's experience. So when if you take the AI power tools, the agent can actually truly help the client define a life objective that is his, such as saving for retirement or the children's studies, and then be able to illustrate all the possible outcomes, looking through thousands of possible scenarios to make sure that the client understands the risks he's taking and the probability of attaining the objective, and all this in order to basically take the best possible decision for the investment. So that's at the beginning, and then through the life span of the investment, the robo will monitor the customer portfolio on a daily basis, automatically rebalance the allocation to ensure risk management is there, suggest options to support the financial goals of the customers, and all these things.
Thank you. And Are there any threats for carriers brought by the adoption of Robo Advisors? Adina, still you, please.
Yes, I believe so. Because the point of Robo Advisors is being an automated management advisor without much human intervention. So I think the primary risk would be that the carrier doesn't worry enough about the algorithms, the way that the Robo Advisor is constructed. So because then it means that he's probably taking the risk of giving potentially access to bad advice to his clients. So I think that would be the biggest threat for the carrier.
Okay, thank you, Adina. So we've talked about some use cases, we've talked about regulation. I would now like to ask Nigel, how important is the ecosystem for a successful implementation of AI solutions in the insurance companies?
It's not how important, it's essential, is my simple answer, because I think this insurance is a team sport. Insurance is there to support other organizations. So if you bring all these back together again, the ecosystem and the efficient orchestration of that ecosystem for me is absolutely critical to bring together all the right participants, people, minds, capability, insights to get to the right outcome that you want. We've never done anything really on our own. If you look at the insurance value chain in itself, from capital through to customer, there are many, many mouths and people to feed, but many participants that underwrite or share or spread it all out accordingly. The more efficient we can make that and the more engaged everyone is together, I think we've got a better chance of success. I don't think this is something that we can do on our own.
Great, thank you. So I want to ask the three of you, what should be at the center of a comprehensive AI strategy for an insurer, so for our audience? Maybe Herman, you want to go first?
Yeah, I think, and I was mentioning this a little bit before, a change of mentality might be on exploring new opportunities on new models. I mean, not try to fit everything to the traditional statistical models. I see that is happening in some insurers, even in the local market. We see insurers having data labs right now, trying to explore, hey, which type of data we have already in our system that we can exploit and try to run new projects. That's the mentality change that we need, I think. Try to see where is the data, maybe we already have it, claims data or market data, etc., and support the actuaries to use these models, these new models, and try to set up joint products.
Thank you. Adina, would you like to go next?
Yeah, so data is at the core of everything again. So, but one of the challenges for an insurer is that they build their systems sometimes for 100 years, right? One on top of the other. So the data might not be in the same place. So one of the big challenge to start with is to give access to all this data to make it work together in order for the actuaries to actually do something with the data cross products, say. And so the data, okay, the data is central, and then we need teams that are able to actually build a deep understanding of all those AI related technologies, maybe build their in-house methods and strategies so they can differentiate themselves from the other insurers, and develop easy ways to access all those smart computations like APIs and things like that. Yeah.
For me, it's I'm going to step away from the technology for a second. I'm going to say ambition, vision, operating model, and permission. And when I say ambition and vision, here I'm talking about, are we doing something in the weeds that is business as usual, just faster? It's evolutionary rather than revolutionary. And you can go through multiple stages. You can go through commodity things that are just procedural, things that have a track record of dealing with similar problems, or actually what is truly evolutionary we could do in our market. So I think the ambition and vision is really important at the outset, number one. Number two, the permission is really important as well. Have people got the permission to, or freedom to roam, to explore, to try different things as described earlier? And that's really important. And then finally, the operating model. Are we geared up correctly? How many times did we walk into the buildings of old where on one side it was one team, on another side it was another team? But actually, imagine what happened if you brought them all together and actually put I always talk about falling in love with the problem. Do we know what we're trying to solve? Back to the ambition and vision. So if we brought people together in a completely different way, would it actually give the ability to get to the outcome faster? And the outcome could be, we tried that, it didn't work.
Yeah.
Thank you. So Adina spoke about data, Nigel, you spoke about vision, but Herman, he spoke about changing mentality. So I would like to ask one final question to Nigel. And how do we overcome this resistance? I mean, how do we change the mentality, and how do we create a right mindset for change within the insurance companies?
As I said, my mission personally is to make insurance lovable, whether you're inside the business or outside the business. My co-host on the podcast, Sarah, always talks about, we've got self-driving cars and drones. It is an amazing industry. We have to keep attracting the right new talent into the organization, number one. Number two, back to your point about ecosystems exist in so many different ways. So I think having seen $30+ billion invested in the insurtech community, having seen 4,500+ insurtechs all identify a problem area and all say, we've got a quicker, faster, smarter way of doing it. That alliance, that partnership between external minds and internal minds and bringing them together is really important. Just yesterday, actually, there was a fintech pledge where people were all signing up to, we will provide fast, easy access for external companies to work with us internally and make sure you get a quick no or a quick yes. Because one of the things that will kill innovation and vision and everything else is taking 9 months to get to a decision.
Yeah.
Right? So speed, it's all, I don't like the phrase, think like a startup or act like a startup, because frankly, you can't do that if you're a 300-year-old organization that's got certain things that we have to do. But by bringing engineering and business together in one cohesive pot with ambition and permission, we then start to create the opportunity to do things, and then decide, are we solving the evolutionary problem? Are we making better models for what we've always done, or are we going to completely reimagine it? So I think just clarity of all of those things brought together will allow us to start changing those things one by one.
Yeah.
Thank you. I don't know if Herman and maybe Adina, if you want to add something.
I can fully subscribe what Nigel said, really.
Great.
Yeah, I agree as well. The good news is there's so many things to improve, so many things to do. There's room for everybody having fun and participating into this changing world.
I will say, if I may, very quickly, I'm a cyclist. For people that don't know, I'm an amateur cyclist, and there's this whole concept of marginal gains that you've seen, and I love it because if you break it all down, improve it by 1%, 2%, 30%, and build it all back up again, it's ultimately better. But what if we just said, let's go for what's our 10x? What's our completely different way of doing it? Are we looking for incremental improvements back to how we measure things previously, or are we looking for exponential improvements? And that's a decision only the teams and the board and everyone else can decide on.
Great. Well, thank you so much. That was our last question. Thanks to our guests for participating. Thanks to the attendees. I hope you guys found the session as informative as I did, and that you were able to get some interesting insights and takeaways. I will now leave you to choose between the two workshops that are coming up next. In the meantime, I give the floor back to Anthony.
Thank you. Before starting you all to the workshops, I think we still have a couple of minutes to take questions from the audience. We have a question from Joseph Pichter. Joseph, if you don't mind unmuting yourself, that would be fabulous.
Yeah, here I am. Can you hear me?
Please go ahead, Joseph. Introduce yourself quickly and then ask a question if you don't mind. That would be wonderful.
Yeah, sure. Thanks. My name is Joseph. I'm working for DCS, which is a large Indian IT integrator, data consultancy services. And while doing that, we had a lot of contacts with insurance companies, and we're also in IoT. And what we try to achieve is to bridge the gap between this more technology-driven topic of IoT and obviously the more traditional world of insurance company. Yeah. Having said that, what we experienced, and I wrote in the message for the chat, is insurance companies still measure business impact in the very traditional way: number of policies, profit per policy, and then figure out, oops, it actually requires a lot of additional policies coming from this brand new area of data-driven products. Yeah. So my question to the panelists is actually, what do you see to overcome this this still traditional way of thinking, way of calculating? Because we tried it several times within a small ecosystem, and actually, to be honest, we failed when it comes to profitability on insurance side. Figuring out we need way more policies than there are potential users, and so nothing actually happened.
Please, German, let's start with you, if you don't mind.
Yeah, no, that's interesting. Actually, we work with TCS in similar things, so that's really great. Actually, I think we also replied to this in what we said before. The change of the mentality will not be something that we can just change from one day to another. I think it's just a matter of helping the traditional insurers and the people working on the actuarial departments to have the right tools and to see the value step by step. We need to we will not come with a new model for car insurance completely based on AI. That's maybe not the insurance do that. Maybe the car OEMs will do that in the future. I don't know. But it's mostly about showing them the advantages on the reliability of these new models, trying to help them also to get models that work with minimum amount of data dependency, so that this is not concerning any privacy or regulation. But I think it's more than an evangelist job. We need to go to them, talk, show the benefits step by step. It's really long, and I agree with what Nigel said before. Sometimes it's we would like that the insurers would be a little bit faster to say, hey, it's a no, because there is no volume, because whatsoever. Because we started, we do pilots, long pilots, where we don't even pay our costs. Yeah, this work of evangelization is really tough.
Thank you, German. Let's go over to Adina. What's your take on it?
I don't have much to add to this.
Thank you. Nigel, let's finish off with the man of the day, Mr. Nigel Walsh.
Hey, let me remind you, this is a team sport, right? So it takes everyone. So I'm delighted to be here with my fellow colleagues. I'd say on this it's a challenge I've had for my entire consulting career. And if the ambition is to get faster horses or more policies in force or whatever else it is, then you have to optimize for that. It really is to the previous point. How do we get people to look at the world in a slightly different lens? Policies in force is a terrible metric if they're unprofitable. If your combined operation ratio is way up, but your policy count's gone through the roof, it's irrelevant. So we got to make sure we're optimizing for the right thing. If we're optimizing for profitability, which customers are we getting rid of rather than adding more to if they're not actually beneficial to us? So I go back to time and time again about how we just choose to measure the new world with new metrics, as opposed to always constrain ourselves with old world metrics.
Good. I think it's about time. Nigel, German, thank you so much for having been with us. Adina, it's been a pleasure to welcome you. Nigel. By the way, where can people follow up with you? Are you on LinkedIn? Please let us know. Nigel?
Adina, go ahead.
Thank you, Nigel. Good. So we are going to open up the session. All you need to do is to click on join the breakout room. You must be able to see an icon, breakout room, and you're free to join the session that you would like to attend the most. It's going to be an interactive one where you're going to get introduced to a use case and where you can interact with the instructor. Please go ahead. All you need to do is to join either workshop 1 under W1 or workshop 2 under W2. And if you don't have the latest version, we do it for you. Drop either W1 or W2 in the chat, and we'll assign, my colleague Frédéric Masquerge and myself are going to assign you. We start the workshops in about 3 to 4 minutes when everybody has joined. Nigel, thank you very much for having been with us. It's been a pleasure. And people can listen to your podcast. You have a podcast, right?
We do indeed. Go to InsurTech Insiders on Apple, Spotify, Google, or your preferred podcast platform.
Wonderful. Thank you very much, Nigel, for having been with us. For all the attendees of the workshops, see you on the other side in a few minutes. Thank you very much. Thank you, Nigel.
Thank you.
Thank you.
Thank you, Alessia. Okay, guys. So feel free to assign yourself. Okay. Feel free to assign yourself. All you need to do is to click on the breakout room icon, and then you can choose between the two workshops. If you don't have the latest version, just drop the W1 or W2 in the chat, and we do it for you. Okay, people are already assigning themselves. Alessia, you can join W2.
Thank you.
Clicking on the breakout room. Okay. Let me take care of Julia.
Anthony, you should assign me, I guess, also, because I cannot.
Yes, of course.
Thank you.
Mr. Okay. Okay, Dita, where do you want to go?
Hey, Anthony, I don't have the button break room anymore, so.
Yes, wait a second. Let me quickly see. Oh, we still have a bit time. Oh, damn it. Okay, there's been a, sorry about that. There's been a small issue. Oh, we still have time, no worries.
People is coming back.
Yes, there's been a small issue. My apologies for that.
Yeah, we come back
Yes.
here.
Yes, so there's been a small issue. My apologies for that. We are reopening the breakout rooms. Please go ahead. Reassign yourself. It's going to take you 20 seconds to do so. Please go ahead. Okay. Pascal, where do you want me to assign you? And then you guys can start. Lisa, where do you want to go?
Will you assign me, Anthony?
Wait a second. Wait a second. German, are you there?
So please do not hesitate. Let's keep this interactive because we are not a lot of people. So if you want to interrupt me or ask questions during the presentation, it's no problem, right?
Allora. Wait a second. Let me come over to you, huh? Okay? Alessia, if you go to Breakout Rooms,
Yeah,
join, you can click on join. You know the number of attendees? You see the number, it's eight twice, right? And then
okay. I see it now.
go to YouTube.
Okay, great.
Okay, see you in a bit.
And also thinking beyond the data that we can generate with black boxes and smartphones, we team up with High Mobility very recently to start collecting data directly from cars and to try to create the first use cases using, I would say, car data without any intermediary, just the data aggregator. So just in a nutshell, what we think telematics has been so far, and what we think is represented in this slide is the early years of telematics. There have been a lot of initiatives worldwide, most of them related to apps and dongles, black boxes, or a combination of both. Some of them being taken, I would say, as lead from big insurers in specific markets. There are not, apart from AXA, there are an alliance, maybe there are not a lot doing that have been doing campaigns in many countries at the same time with the same platform. So it has been, I think, very regional. But all of them were about the same thing: calculating your acceleration, your braking, your cornering, maybe your speeding, giving you points and converting these points into something. I would say the common, the underlying, I would say, coincidence between all these platforms is that none of them touch really the insurance product as such, as we have been discussing in the previous session. So a lot of people, when we go and present about telematics, there are some people that say, no, but telematics failed, because they have this vision of telematics was a black box installed in the car. Black boxes are, they're not being installed anymore, only for fleets. It is true that some of the projects, or most of the projects that failed in terms of insurance telematics, I think we quantify here the three main reasons that we think are the ones, I would say, be more present there. First of all, there have been a high investment in tech and data collection, which was not in the comfort zone of an insurer. So they have built platforms, bought hardware, handled the logistics of the hardware, etc. In order to start collecting data and right away giving discounts to customer without touching the product, as I said before. And the result of all this was, in terms of volume, those value propositions that most of the initiative did were not paying back the investment. And that's why there is a kind of idea that telematics failed. However, there are some cases, I cite here only two, but we might find more, that I would say they are successful. They have been successful. Progressive, and also more recently in Germany, Coburg. These are two cases in which there has been a long-term investment into telematics, with an idea not in the short term try trying to get customers because of telematics, but try to get the value of the data and to rely on telematics to build the next generation connected products. In the case of Kovu, for example, they have been investing heavily into devices, equipping people with those devices just to collect data and claims at the same time, and be able now to have a more, I would say, simple platforms based on application, but with solid models behind. So I would consider that as the successful early adopters. But what is the game changer today? So as I said before, one of the reasons to fail have been the investment into data and hardware in a more, I would say, opportunistic way. Today, the game changer is connectivity. So it's no longer the insurer who has to invest into hardware to equip the cars to produce the data. The cars are connected. The cars are equipped with head units that are able to produce data at a relatively, I would say, good sampling frequency, and this is increasing in the last months for all of them, that is able to provide to insurers the information they need to run data-driven products. So I think we are now in a process in which this could be really the game changer, and where we could see new telematic opportunities being present for companies like us, as Motioness, but all others also, of course, and to think about data-driven insurance, not only to insure the car, but to insure your mobility. So that is a very important point from our perspective. So in terms of the connectivity, if we focus in particular on data coming from cars, how is the market now structured? We have OEMs starting with BMW. I would say in 2017, there was the first launch of the car data API and the first model equipped with head units able to produce data. But right now we just put some logos here of OEMs producing data and having APIs and platforms. But this is now in production. It's no more staging environments. And on top of that, we have companies like High Mobility, Caruso, Smart Car, Autonoma that are aggregating them to give to insurers or to fleets, to everybody aiming to use car data to run the products, a unique point of access to many brands. So they are just an interface to translate different pieces of information coming from the vehicle into a common space, into common naming, right? So this, I think we need to keep an eye on these two sectors and see what is, so for insurers, for example, what is more interesting, if to launch products, for example, for a certain brand in a certain region and then consume data from their API, or to think broadly and look for data aggregators. So this is not our phrase. This is a phrase that I have been hearing about insurance, and in particular telematics, is disruptive or be disrupted. So we are in a moment now that either the insurance say, okay, we consider this game changer or this opportunity, and we go forward and we try to put innovative products in the market, or we could get disrupted. My vision is that getting disrupted is a risk that they have, mainly from whom? From the OEMs. If you see in the past months, beginning of this year, Tesla officially launched an insurance product directly from the dealership. You get the car with insurance branded Tesla, which is fed with their own data that they get from the car. We know that there are other OEMs in Germany working with reinsurance companies trying to set up their own pay how you drive, as you drive products. So this is coming. Of course, the OEM now is in a position where they have the data. They don't need to invest on data, they already invested. And one use case of monetization is insurance, right? There is after sales also, of course, there is associated services to the driver, but insurance is one of the services that could be as a monetization case for the data that they are producing. So, but it's not that the insurers, they don't disrupt because they don't want to disrupt. We need to accept, and I think you all agree, you will all agree with me, that the complexity of doing insurance pricing is high. It's not just pricing a pen, summing costs, putting a margin. No, doing insurance and being, and I'm not an expert in actuarial science, far from that, but the complexity is about understanding what is triggering your cost and to have models that position your product well in many, I would say, in a broad spectrum of segments of customers. So to be profitable on all of them. That's the complexity of pricing, and that's why when we try to add new variables on those pricing models, it gets really complex because we cannot understand what is the final value of the end of the equation of putting a new variable, like, I don't know, coming from car data into the equation. So what is just to go a little bit more into detail, this is all about claim data. So if we want to incorporate new variables, new data coming from the cars in order to make insurance, we need to understand how this data explain claims. In two ways, of course, the claim frequency, so how often these claims are coming, and the claim severity. What is the cost that these claims are producing to the company, and how these new variables explain that cost and that frequency. Of course, this information is not available on Scratch, so it's very unlikely. There are only a few companies, insurance in the market, that have telematics data and analyze already car data for the same people that have produced claims in the past, and they are able to work on models. So the number of claims and the claim costs need to be predicted. And as I said before, we need to do this exercise for different customer segments. So we need to see which are this new data that we can put into the models that can increase the competitiveness of the tariff in every segment. That's the challenge. So when we talk about data for modeling, what are we talking about? Today, we have what we see on the left, which is more the static data. So vehicle information, driver information, I don't know, gender is not being accepted into Europe, but in other regions, yes, but age, where you park the car, etc. Your claim history, that's the static data again, and maybe some external data, I don't know, your scoring or your credit scoring or your records, so static data, I would say. What we are adding here is what we call dynamic data. Dynamic data is about data that is coming for every single day of driving, every single trip that you do. And this could include how you use the car. So it's not only your harsh maneuvers, but it's where you drive, which failure codes, for example, you have in the car and you are driving with failure code being enabled, which are the different events that you trigger, what is your context of your driving, do you drive with traffic, with no traffic, risk scoring. So do we have an idea of which are the risks you're exposing to? And very recently also ADAS, so adaptive cruise control, or everything that automate a little bit your driving. You can have cars equipped with good level of ADAS, but how are you using it? Are you using it in a good context with the, in the good way? And this is something that, of course, need to be taken into account for the new models. So again, as I said before, here we have what we call the chicken and egg problem. So how to add this new dynamic data into models if we don't have a clue on how they can explain the claims? And that's one of the limitations when we want to talk to insurers, say, hey, we need to do dynamic models, yeah, but I want to be sure that these new variables that you are giving me can explain the cost that they have in terms of claims properly. So I think there are two visions there. The vision that they call here the short-term vision is the one that we have been looking in the market so far, which is we launch applications or platforms, including dongles, black boxes, or just smartphone data, in which the driver produces data, we give him a score. And of course, this score have no correlation at all with the claim. This score is not linked to the tariff. And this score is only used to coach the driver, and we think that because of coaching, he will get a better driver and maybe he will reduce the claims. But there is no impact on the tariff. The only impact in the tariff is your bonus malus. So every time you do a claim, you will be impacted negatively in your premium. So what we think about the long-term vision? And the long-term vision we see here is mostly to overcome the problem of not having claims data at the moment of a policy issuance of a data-driven or a connected product, right? So there we need to start thinking more about risk factors, not only about scores. And in order to build risk factors, we need a kind of a baseline of risk data. Here at MotionS, we have been developing a platform that uses road safety statistics, meaning can we explain from the data we collect from a driver, not the number of claims and the severity of claims they explain, but in terms of road safety statistics, which are the patterns of driving that we see in this person during the driving that explain fatal, serious, slight accidents in different contexts. This is already, I would say, a next step from the current approach, which is just based on basic scores without any risk orientation. We will have, of course, we are not working with claims, but we can work with road safety data that is open and public, so the insurers can consume road safety data in different regions. And we will have a higher correlation to claims, of course. And the insurance can take the risk to dynamize the price using risk factors, not only scores, supported by road safety statistics, but with the long-term vision, which is we collect driving data, we collect car data in order to be able to have a connected car tariff in the future when it will collect claims at the same time. So this is a kind of way of solving the chicken and egg problem. So if I don't have the claims data at the time of the design of the tariff, I can use a proxy, which is the road safety information, until I get into the moment that the claim data will be enough to model a new pricing using these new variables that we are dynamic variables that we put from the vehicles. So I don't know if you have any questions so far on that. If not, I would like to explain a couple of use cases that might sound interesting for you. So if there is no question, and we can just go forward on this, I would like to present you 4 concrete innovations or use cases to anticipate and prepare for the upcoming challenges. We just selected a couple of background images there, and one is very recent. It's about this Tesla crash that's happened in Texas with and they discovered the dead people inside the car, but there was no driver. Nobody was in the driver's seat. So how are we able to, as an insurer, to discover these kind of situations? And actually, this would be a very expensive claim for them, right? Before going into that, just what do we do technically in a nutshell? We have a platform on MotionNet that processes data coming from smartphones and from cars, dongles, devices, car data. And we do 2 things. We augment the data with maps, weather, traffic data, and then we do the profiling. In terms of risk, as I mentioned before, we use road safety data, but our goal is to provide to the insurers analytics that can be just incorporated into the pricing. That we position ourselves not just providing scores, but multipliers for the tariff. And this is what I present here as the first use case. And this is what we are doing with Adacta, which is an Slovenian core insurance system company, mostly selling to German insurers, from what we know. And the artifact that we have been working with them is a translator between the telematics variables that we can get from a vehicle, including aggressive driving, tailgating events, everything that we can get from the vehicle, from which we have road safety data to weight it, to give an importance to that metric, and how we can incorporate that into an insurance product. We think that the easiest way to incorporate these variables into products that already exist, into a tariff that are already structured, is to ask the actuary to decide what is the weight he wants to give to telematics. So if I have a car insurance product and I want to start collecting car data and dynamize a little bit the tariff in a controlled way, we can ask the actuary and the product manager, what is the maximum discount and the maximum increase you want to give? Let's say minus 20% plus 10%. And then what our platform can do there is by using a big training data set that we have been collecting for many years in Europe, to position the driver into the distribution of, I would say, thousands of drivers, and tell if this guy should be granted an increase or a discount for different levels of coverage. Could be a casco, could be windshield protection, animal impact. So we can have variables to explain each individual coverage of the insurance. And that's what we plug and play with the insurance core systems. That's the first innovation that we call a dynamic pricing tool. So it's not only the scoring and the profile. The second one is the usage of car data. We really think that the game changer is connectivity. That's why we got our first pilot with a local dealer in Luxembourg, Villa Emond, powered by the High Mobility as a data aggregator. And actually here we have been able to connect 40 vehicles from a fleet in the last month. And we start, so this project is about understanding which type of data we can get from the car, which is not the full trip data that you can get with the dongle. You get events and some locations, and you need to infer from there the risk. So we are working there on the models because we cannot have exactly the same models that we have with high frequency sample data, right? But if you're interested into car data, also we can discuss later. And the third one, we decided to apply for funding for a PhD project together with the Luxembourg Research Fund, funded by the National Research Fund, and in collaboration with the University of Limerick, which has a big department on risk assessment, on emerging risk assessment in particular for insurance, with the vision of how we will ensure not only the autonomous vehicle, the level 5, but the different levels of autonomy. So every time we increase the level of autonomy of the car, there is the driver that is controlling less features, but also having to be reactive to disengagement events. How do we measure those disengagement events? How these events are producing more or less risk, etc. And we are working on a project on that. Some of the first results, so we are conducting simulations on different levels of autonomy. But what we can see already is, and this has been already forecasted by KPMG. There was a very nice report on what is the impact on insurers of autonomous drivers, and we see that there will be I would say a 63% decrease on the total loss, but it doesn't mean that the frequency and the severity of the claims will be reduced. It's mostly about frequency. Frequency of claims it's planned to be decreasing. The severity is still not clear because the cars are extremely expensive. They have, I would say, complex electronics. So every time there is a crash and we need to repair, it will be more complex and of course more expensive. So a claim per unit will cost in average more, but the drop on the frequency will be so significant that this will reduce, I would say, the total loss. However, what we are investigating here is how this will be the case in different, I would say, periods during the transition to connected and autonomous vehicles or automated and autonomous vehicles. Because there will be coexistence with the normal drivers, there will be different levels of automation at the same time, and this will need to be taken into account by the insurers. And last but not least, we try to go also beyond using the data coming from your mobility for doing car insurance, but to think more into the perspective of holistic mobility insurance and also situational insurance, to help the insurance to discover situations that are with data, of course, that can be insured, and to use that data to help them to do the pricing on the spot, and to, I would say, to ensure the opportunity of the person being exposed or potentially being exposed to a certain risk. So these are some examples, but this goes beyond your mobility. It's aiming also to take a look into your long-term behavior, your habitudes, and try to help the insurers to see long-term opportunity to sell something to the customers. This is a project that we are submitting to the Ministry of Economy for research and development and innovation, and partnered with Lux Innovation and with a couple of local partners here in Luxembourg too. And just as a summary, as a conclusion, I think it is important for the insurers to make them understand what is the value of mobility data beyond pricing, as I was saying before. It's not that they need more data to do pricing. This was discussed during this presentation, but the benefits goes beyond. So of course, first of all, they can get deeper insights in mobility and the profiles to do two things: upselling and cross-selling mostly. So to modulate the coverage, for example, and do upsell, but also to identify new opportunities and to, for example, to someone that have car insurance with you sharing mobility data, if you distinguish opportunity to sell home insurance, life insurance, health insurance, you can go forward with a certain, I would say, a priori knowledge using data. The second is the increasing the reactivity. If you have data on the spot, you can distinguish selling situations on the spot. And of course, increase the customer relationship. Today, the customer relationship of an insurance is at the time when you subscribe the product and when you do a claim. So maybe what we need to think, how to leverage on data, and in particular mobility data, to have many touch points and positive touch points with the customer. And the third axis is about assessing new risks. So it's not about assessing better the risks we have today, but also use data to discover new risks that will appear. There is, for example, a trend in cybersecurity now. This is a new risk. Of course, we will need data to assess the risk of that. But in the mobility sector, this is linked also to the autonomous driving project that we are doing. We need to prepare the insurance to understand these new risks that are happening. It's not only the collision because, I don't know, you were speeding. Is the collision because maybe the sensors of the car, of the AI being in your car was buggy at that time because of a certain condition, and the insurance, of course, is not aware of that at the time of the policy issuance. So I think these are the three, I would say, main values that we need to push forward when we talk to insurers to maximize our chances also to convert or to transition themselves into the tradition, from the traditional way of thinking to the more data-driven way of thinking. So that's all from my side, but I'm very happy to take your questions.
Very good, guys. Please go ahead if you have one or two questions left. One or two questions left to German. Please go ahead.
I have a question. This is Joseph again. Can you hear me?
Yes, please go ahead.
Thanks. So my question is related to the last topic you mentioned. German is the right way to pronounce it?
Yes, that's perfect.
Okay, German, which is about new risk or better detecting risk. What I'm asking myself, and I would be interested in your idea about that. I mean, take the case someone is a very experienced driver, yeah, and constantly going over speed limit, which might actually draw a picture which is high risk because you're always above speed limit, but being very experienced, it's not the real risk. You know what I mean? So if I can really drive a car properly at high speed, at let's say good road conditions, the real risk might not be that high, but collecting these traditional parameters, it actually shows a different picture. How do you cope with situations like this? Because you mentioned KTM, I would assume in motorcycles it's even worse, right?
Motorcycle is even worse because if you buy a motorcycle and on top a KTM, is because you like to race. You know, their slogan is ready to race. But I think sorry,
I'm riding one of these KTMs, ready to race.
So, but I think you partially mentioned that the response into your question, because the key aspect there is the context. I mean, you can be a safe driver because you know you have experience, you're speeding a little bit, but something could happen. The context could challenge you. So there could be traffic, there could be road topologies that are not safe and that you cannot anticipate. Of course, if it's a route that you know, why not? But I think putting on top of the data you produce as a driver, speed, acceleration, braking, etc., the context, and trying to understand at which risk we're exposed to with that behavior for that certain context, that key. And that is exactly what we're doing with KTM. We are not penalizing speeding, for example. We are penalizing stupid speeding, if you might allow me. So in places and locations and situations where speeding is not responsible, it's not. I mean, you can allow fun, you know. And actually, we develop without going into the details, but we develop a specific model to support different levels of speeding in different contexts for the KTM project.
And what are you adding to set this context? I mean, I don't want to hijack the whole audience, but because is it weather or what kind of?
Exactly. We put road topology information, we put weather information, we put road signage. So we anticipate in your trip the signage that you are approaching: stop, give ways, roundabouts, pedestrian crossings, etc. But I would be happy if you want in the future, you just reach me and I do a demo with a couple of trips. What we are doing.
Super interesting. Thanks. I don't want to take every opportunity to ask questions. Sorry, but thanks for your input. Very interesting.
Thanks to you.
Start by sharing my screen. So feel free to ask me a question during the presentation. I will try to answer. So my name is Helena Jmedin. I have a PhD in artificial intelligence, and I'm working in active asset allocation as the head of the research team, especially on artificial intelligence. So I'm going to present you, first of all, active asset allocation, and I will present you 3 types of examples where we are using intelligence artificial in our models. So feel free to ask questions if you're not able to understand, or if I'm not explaining it well. I will try to use very clear words. So first of all, active asset allocation is a digital financial engineering fintech using artificial intelligence. We have been making dynamic asset allocation model for 10 years using a proprietary risk management methodology. So as you can see, we have different fields of expertise. As Adina said, in actuarial studies, asset allocation, asset management portfolios for insurer, research on IA and digital platform. We have our own digital platform and our Robo Advisor. So you can see here, we work with institutional client, insurer, pension fund, portfolio manager on asset allocation issues. We have also developed last year during the COVID year, we were working from home. So we also developed APIs coded on Python, which are cloud native and encapsulate all our know-how to serve the distribution network for our insurance and banking partners. So you can see here that we are using AI everywhere. So during our digitalization transformation, we start using more and more artificial intelligence algorithm to automate certain tasks and gain productivity. We were like spending sometimes a lot of days doing one process. So now by using artificial intelligence, we are able to do it faster with a very good quality. So for example, for the stochastic designing of our model, we are using genetics algorithm. For our global risk indicator, I will present it for you at the end of the session. We are using machine learning supervised method for optimization. So yeah, we start using a lot of these techniques, and you can see, sorry, it is here in French, but in all our process right now, we are using artificial intelligence for data processing, for giving suggesting a portfolio, optimizing portfolios, for natural languages. So all these models are actually used on our platform, and they are already in APIs, and our client can have access to it. So I will give you 3 big examples of what we are doing in active asset allocation and how we are using IA to increase the quality of our models. So I will start by the dynamic asset allocation. So the question that we can ask, why we control the risk or the maximum capital loss. So here is a very, very good example to show you. In green, you can see the line illustrating the mathematical relationship between given, I'm sorry, I will put it like that, it's better, between when we are suffering from a loss and the performance we need to recover the loss that we get. So if we take, for example, here the blue cross of the emerging market, if we lost 70% of it, we will need more than 20% of performance just to go back. And the 2020 years was really the example why we have to manage the drawdown more than the volatility or something else in our portfolio, because it will cost us a lot to come back to the initial point after loss of capital. So to do that, we create our own proprietary methodology, which we call DARM, which is Dynamic Asset and Risk Management, which is a combination of a risk management method. So if you are familiar with the CPPI method. So it is just combination between a risky asset and a safe asset. So we have this small structure. We just integrate it in another way into this big structure like a tree. And we can see here that we are going to combine a risky asset with another asset to provide a new asset, which is a combination of the two. And we'll go on, we are going to combine it with another asset till we arrive on the top. So the assets, when we are talking about dynamic asset allocation, they are not going to be at the same level, but they will be like in small structure according to the risk till we arrive at the final DARM structure, where we are going to manage the drawdown and to maximize the return. But to do that, we can think that the best and easy way to do it is to go and to work with the historical data to optimize the portfolio under constraint. But in active asset allocation, we don't work at all on historical data. So what we do is we are going to simulate thousands of scenarios for each asset, including different type of scenarios. We have here in this structure several parameters like multiplicator, the constraint of minimum and maximum allocation to the core and to the satellite. So all these parameters, it is difficult to get them by manual work. So we are going to call IA to do that. So first of all, as I told you, for each asset, safe or risky asset, we are going to create a scenario stochastic simulation to make it possible to test with scenarios, optimistic scenarios or pessimistic scenarios. So it is better than just backtesting it on the historical data. And to do that, we are generating these simulations according to the filtered historical simulations. So this is the first step. So you can see that we have 1,000 simulations for each asset. Imagine if we have 10 assets in a portfolio, if for each DARM we have 5 or 7 parameters to identify, you can see what is the complexity of the task. So what we are going to do is we have the simulations, first of all. The second step is to identify the parameter. To do that, we are calling the genetic algorithm to identify the best value according to constraint, horizon, what the client wants from us to manage. So I will give you a quick view about the genetic algorithm. So just from a first population, we are going to have a crossover and mutation till we arrive to the second population. If the evolution is telling us that we are going in the right way, we'll keep on going on till we arrive at the optimal value. So here is the example. If I'm going to do that on thousands of simulation manually, and for each structure of the DARM, there is like 5 or 6 parameters to identify, the task is huge, and I don't know if I will be able to provide the best allocation. So we can see here, based on IA, I'm sure that the portfolio that I'm going to select will have the best maximum drawdown for the maximum of return. So, and at the same time, we can be sure that according to here, the space that we are inspecting, what we are pulling is really the good parameter. So here you can see what I was explaining for you for the dynamic allocation. So first of all, we create our portfolios by associating risky assets and safe assets. We make the simulations and we optimize the parameters till we arrive at the portfolio. So the idea is to have lower drawdown, better return, or both of them. So if you have here a quick look, for example, I can here show you the stat on the DARM 5. So we are working on stochastic simulation. So I'm not going to give one value, but it's going to be thousands of values. So that's why we are going to check the quantiles. So usually we are checking the quantiles on a horizon of 5 years. So here we can see what is the return expected for DARM 5 for 28 of drawdown. But when we are going to encapsulate all these DARM one after the other till we arrive at the end, we can see that the expected drawdown of the structure is just -7. So even if we have risky assets, and on the top, the portfolio that you are creating will have just 7 of drawdown and expected return of 8.8. So here we are really pulling the maximum of benefits from our assets, really being heavily invested when everything is fine and go out when the market is in bad situations. And what we are doing is also we are rebalancing our portfolio. That's why we are calling it dynamic allocation. We are rebalancing the portfolios once a month or according to the request of our clients. So this is for the dynamic allocation. The second example I want to show you today is for the strategic asset allocation. So strategic asset allocation is also a big question and very important question, because we have to find on the long term what is the best allocation to take. And we are not going to move it because it is strategic allocation according to a horizon, to certain cash flows of the client, a project, or risk of volatility and risk of drawdown. So why in active asset allocation we are different? We are, first of all, as I show you for the dynamic allocation, we are not going to backtest it, but we are going to work on stochastic simulations, first of all. Second, we are going to adapt our process to each client. So we have customized model that will take the client, and we are going to give him just an individual allocation just for him. So it's not just going to be the same allocation for everybody. We are going to optimize under risk and under drawdown, and we are able to propose different type of allocation according to the risk level. So once again, it's a huge task. Imagine that we have like 20 assets with a step of 1% of a delta. We can see that finding the best allocation manually is just impossible. So what we are going here to do is we are going just to apply the optimization to be able to find the best maximum, global maximum allocation, and not going through a local one, or even not at all the optimized allocation. So we are going to deal for each asset with thousands of simulation of scenarios of the market. We are going to work on quantiles, not on one value, and we are going to propose the best allocation. So here we can see that same as I presented for the dynamic allocation, we are going to pull the portfolio, the optimal portfolios having the lowest drawdown with the biggest return. We are not going to work on Sharpe ratio, but we'll work on MAR ratio to optimize drawdown the couple, because for us, the risk is very important. So we are going to optimize the couple of drawdown return. So we can see here, when we are optimizing, we can optimizing all the portfolios that we have on a certain quantile. So here on quantile 25, 50, 75. So for example, here to give you an example, on the quantile 25, the best portfolio is the yellow one, who is having the lowest drawdown for the best MAR ratio. Let's say it like that, it's better. So it depends. If the client is having an objective and he don't want to take a risk, we are going to give him the best allocation provided under the quantile 25. If he don't care, if he really want to take a risk, we can provide him this portfolio. Or better, we can provide him the all-weather portfolio, which is having the best drawdown in all quantiles. So we can see here an example. So each time when we are testing an allocation, we want also to be sure that what we are presenting or suggesting as a combination of allocation is really better than what he was having before. So we can see here that for a given portfolio on a horizon of 10 years, the number of scenarios arriving up above the objective are just 47% of the scenarios. After optimization with the all weathers, we are having 68. So you can see here that the number of scenarios, positive scenarios above the objective are higher. And also we can see on this graph, on this histogram, we can see that we shift the value of the scenarios here a little bit to have a lower, higher value, higher amount. And the distribution is just shift. The colors really present it how it is shifting. And if we go to the stats, once again, I told you that we are not working on one asset, but on one scenario. We are working on thousands of simulations. So the final portfolio was having before 1.9% of a possible return on a horizon of 10 years compared 50. With the optimized allocation, he will get 3% of a possible return. So we are also having better drawdown, so 26 to 20, and we are still under the same volatility risk of the client. So 3.5 and 5 are still under the same SRI, which is 3. So yeah, here where we can say that just managing or providing the best strategic allocation is going to be according to the best drawdown, coupled drawdown return to optimize the portfolio on the long term. And to give you here also the last example, which is our GRI, a global risk indicator. So this is an indicator which is an aggregation of macroeconomic risk and sense indicator developed in active asset allocation team since years. So first of all, we have lots of indicators and we select the one who's having the strong prediction and correlation with the market crash. And the idea of this indicator is to identify the crash market 20 working days before. So just when we have this kind of information, we can de-risk our portfolio to more safe assets if you are heavily invested in risky assets. So to do that, we are counting on artificial intelligence algorithm and especially on supervised machine learning techniques to give us the signal of not the prediction on the market on 20 days, but a good idea of what will happen in the few days to go. So to do that, we are counting on data since 2006. We are dividing the data. So we are collecting data for sure from Bloomberg, and we are going to split it into learning data, testing data, and the final set is going to be the validation. And the validation of our GRI signal prove that we have a good percentage of alert. So I will show you here what is the output of our GRI signal. So it is going to be a signal varying between 0 and 100. And when we are going to cross a threshold of 55, that means that we are in alert zone. So we have to do something to our portfolios, not to let them heavily invested till the GRI went below 40%. So how we are creating these signals? So based on IA, we are going to select the indicator that they are heavily correlated with the market crashes or good predictability. We are going to process to a certain number of transformations. We don't use usually raw data because it is not, sometimes the information is just hidden a little bit. After we are going to apply the process of supervised learn. And as I told you, the GRI is formed by different indicators. We have the weight. These weights are going to be adjusted daily on a daily basis till we arrive to the final output, which is our signal, green signal. And this signal will be an input in our portfolios. So if he said that there is a crash maybe in the 20 coming days, we are just going to de-risk our portfolios. So to give you a concrete example of how the GRI is really helping us sometimes to save the portfolios and to reduce the drawdown, what we can see here is the Eurostocks in blue. And on it is the supervised signal by the strategy of degree risk on risk off. So we can see that we don't drop into the crash market of 18 for this kind of example. And here we avoid also going down like what's happened on Eurostocks. And we, once the signal said that the alert is off, we are invested. So this is an example. Another example is on the emerging markets. So as I told you, we are sometimes the other problem is he's not efficient 100%. It's just an indicator, because when we are designing our model, we are taking into account also very optimistic and pessimistic scenarios. So the DARM by itself or our model by itself are good, but we are using the GRI as an extra information to reduce in case of alerts, the drawdown. So we are using the GRI in two ways. First of all, in the DARM structure, we have the multiplier, and we can adjust the multiplier according to the value of the GRI. And we can use it also on daily monitoring. And for example, in February 2020, we just proceed to an earlier intra-month rebalancing because some of our portfolios were running out of risk budget. And we were not even expecting this kind of drop. So when the GRI said that there is a problem, we just de-risk our portfolio and we avoid them to go deeply in very hard loss. So that's it. If you have any question.
Hi, I have a quick question. At some stage during the presentation, you mentioned genetic data for your samples. I just wonder, like, how did you get to? I mean, how do you get those kind of data? What are the source? And what historical of data you have based on that, on genetical factors?
For the genetic algorithm, we are using the simulations. So this is the data. So maybe I didn't give you a lot of information about it, but we have assets, like for example, the S&P or any bond or any equity. What we are going to do is, first of all, we are using Bloomberg to pull the data of the assets. So we will pull the historical data of the asset in the last 15 or 10 years. The idea is to pull data having upper and positive market situations. Then we are going to simulate. So we don't depend on data from outside. We just depend on the last 10 years. We are going to simulate the asset and we are going to feed these data to our genetic algorithm.
Okay. Thank you.